Your parents might believe they're set for retirement, but most have no idea their savings are vanishing, and any hope of a safety net is disappearing. Illinois cannot even process retiree health care for a year. Across the country, 50 million Americans are racing toward retirement with a median net worth of $184,000, barely enough to last a few years. Millennials will be forced to pick up the pieces, but almost no one is talking about how deep the crisis really is or what happens next. In 1978, a single clause tucked into the Revenue Act quietly rewrote the rules for how Americans would prepare for old age. Section 401k allowed workers to defer part of their pay into a tax-advantaged account, a technical fix meant for top executives. But within 2 years, benefits consultants like Ted Benna realized the law could be used for everyone. The first 401k plan launched at Johnson & Higgins in 1980, offering regular employees a chance to save pre-tax dollars, with matching funds from their employer. The idea spread quickly. By 1981, the IRS confirmed salary deferrals were legal, opening the floodgates. Wall Street and big fund managers seized the opportunity. Early brochures promised your money, your control, and tax-sheltered growth. Fidelity and Vanguard pitched 401k plans as the modern answer to declining pensions, while consultants distributed starter kits to companies promising easy setup and big returns. Slogans like "turn salary reductions into tax-sheltered growth" beat the pension decline appeared in trade magazines. By 1983, half of all large employers were offering or building 401k plans, and total participation shot from a few thousand to more than 3.6 million in just 2 years. The promise was simple: hand over your savings, let the market do the work, and enjoy the rewards later. Traditional pensions faded as companies shifted risk onto workers, and a new culture took hold, one where retirement security depended on individual investing and the ups and downs of Wall Street. By the early 1980s, a new way of thinking about money had swept across American households. Saving was no longer the default. Instead, spending became the measure of success. The doors opened wide when banks and credit card companies began to loosen their standards. In 1980, total consumer credit stood at just over $350 billion. By 1990, it had doubled to nearly $700 billion, according to Federal Reserve data. Credit cards, once reserved for the well-off, flooded mailboxes in every neighborhood. Advertisements promised instant approval and no annual fees. Department stores, gas stations, and even airlines pushed their own cards, each one offering a slice of the American dream on borrowed credit. The old habit of putting away 1/5 of every paycheck faded fast. National savings rates, which hovered around 12% in the late 1970s, crashed to just 4% by the end of the 1980s. For the first time, debt was not a sign of trouble. It was a way of life. Households used credit to buy homes, cars, vacations, and the latest electronics, all while feeling richer than ever. The logic was simple. Why wait when you could have it now and pay later? As credit became the safety net, families stopped worrying about the future. The market was supposed to keep rising. 401k plans would take care of retirement, and if things got tight, a new card or a home equity loan would fill the gap. The entire system quietly shifted. Americans were not just investing in the market, they were depending on it to bail out their spending. That risk, hidden beneath the surface, would soon test an entire generation. Every 8 seconds, another American turns 65. The scale is almost impossible to grasp. 3.9 million people retire each year, every year, through at least 2027. This is not a gentle tide. It is a demographic flood, as the entire baby boomer generation, 76 million strong, hits retirement age all at once. In 2018, the average boomer turned 64, matching the traditional age for leaving the workforce. That year, something subtle but historic happened. For the first time, the wave of retirements crossed the peak of a long economic boom. Labor force participation, which measures the share of adults working or looking for work, had been steady for years. But in 2018, it began to slip. The overall rate edged down, even as unemployment numbers looked healthy on the surface. Among Americans 55 and older, participation dropped from 41% in 2017 to just above 40% in 2018, and it kept falling. By 2025, it is projected to reach 38%. For those aged 60 to 64, the drop was even sharper, a 2.5 percentage point fall in a single year. Charts from the Bureau of Labor Statistics and the Census Bureau show diverging lines. Older workers exiting, younger cohorts barely filling the gap. Prime age workers, ages 25 to 54, held steady or even increased their participation. But it was not enough to offset the exodus. The illusion of strength in the job market masked the reality that millions were simply stepping out for good. This is the first time in American history that so many people have left the workforce at once, not because of layoffs or recession, but because of age. The fuse is burning. 3.9 million retirements a year every year compress decades of exits into a single relentless window. The timeline is set, the numbers are locked in, the consequences are about to show up on every household balance sheet. Picture a typical American household headed for retirement. On paper, the numbers seem reassuring. The Federal Reserve Survey of Consumer Finances puts the median household net worth at $184,000. But the breakdown tells a very different story. Only about $45,000 sits in stocks or mutual funds. Home equity adds $53,000. Pension entitlements, if they exist, average $44,000. Liquid savings, just $18,000. That is the full ledger for the median family approaching retirement age. Now stack those assets against the cost of living. According to the Bureau of Labor Statistics, a retired couple needs about $45,000 a year to cover basic expenses, housing, food, transportation, health care, and taxes. The average pension payout in the United States is $23,000 per year. If the household draws down all their savings at a steady rate, that adds roughly $9,000 annually. Combined, that covers just $31,000. There is an immediate $14,000 gap, almost a third of what is needed just to meet the basics. The math only gets tougher with time. Medical costs keep rising, and many retirees will live well into their 80s or 90s. The longer the timeline, the more the shortfall grows. Home equity is often seen as a last resort, but selling the house or taking out a reverse mortgage comes with its own risks. For most, the family home is both the safety net and the final asset to spend down. This is not a worst-case scenario. These are the numbers for the median household, the one right in the middle. Above them, a small sliver holds millions in assets. Below, tens of millions face even less. The shortfall is not a distant threat. It is a baked-in reality, quietly waiting on every household balance sheet. The promise of a comfortable retirement depends on a math problem with no easy solutions. Retirement savings in America have never been more exposed to the stock market. According to the most recent allocation surveys, households nearing retirement now keep about 70% of their financial assets in equities, stocks, mutual funds, and riskier alternatives like private equity and venture capital. That is a dramatic departure from the norm. In Europe, for example, the average retiree holds just 20 to 30% in stocks, with the bulk of their savings in government bonds and cash. This concentration is not just a matter of preference. For many pension funds, the old playbook, relying on bonds to deliver steady income, no longer works. Interest rates have hovered near historic lows for over a decade, leaving bonds unable to generate the returns needed to cover promised benefits. In response, pension managers doubled down on equities, chasing higher yields in a market already priced for perfection. The Wilshire 5000 Index, which tracks the entire U.S. stock market, now trades at a price to GDP ratio that eclipses even the dot-com bubble. The Shiller-Cape ratio, a classic measure of valuation, stands at levels seen only twice before, 1929 and 2000. For individual retirees and public pension systems alike, the bet is clear. Stocks must keep climbing or the math falls apart. But with so much riding on a single asset class, the margin for error has vanished. If the market stumbles, there is nowhere left to hide. Unlike prior generations, this cohort is all in at the top with little protection if valuations reverse. The risk is not just personal, it is systemic, woven through every pension fund and household account in the country. For decades, the rhythm of retirement investing followed a simple pattern. Workers funneled billions into 401k accounts and IRA accounts, buying stocks with every paycheck. When markets stumbled, new contributions poured in to buy shares at lower prices, setting the stage for each rebound. That cycle is now broken. The largest generation in history is no longer buying, they are selling. According to the investment company Institute, 401k and IRA net flows turned negative in 2020. By 2024, withdrawals outpaced contributions by more than $450 billion. The math is relentless. 3.9 million Americans retire each year, and nearly all must draw from their savings to cover basic expenses. Required minimum distributions at age 73 force even the reluctant to sell. Younger workers, burdened by debt and stagnant wages, cannot fill the gap. The median age of contributors has climbed to 52, while the median age of those withdrawing has dropped to 68. There are simply not enough new buyers to offset the millions of retirees cashing out. In past downturns, fresh contributions softened each blow. Now, every dip is met with a wave of forced selling, not bargain hunting. The result is a market dynamic never seen before, a structural imbalance where sellers far outnumber buyers, and every rally is weaker than the last. For the first time, recovery itself is at risk, not because of panic, but because the demographic math no longer works. Raoul's father used to trade in his car every 3 years. A new German sedan, always under warranty, always spotless. Now that same car sits in his driveway, 15 years old, the paint faded and the odometer rolling past 200,000 miles. He keeps a notebook tucked in a kitchen drawer, tracking every dollar that goes out, groceries, utilities, insurance. The steak dinners and summer vacations are gone. Every expense is weighed, each purchase second-guessed. Over the last decade, his monthly spending has dropped by more than half. He's not alone. Across the country, retirees have cut their consumption by 60% on average, based on interviews and household budget surveys. The reason is not a single crisis, but a slow, grinding math problem. Fixed income, uncertain health, and the fear that money will run out before life does. The ripple spreads far beyond one household. Gasoline sales have flatlined, even as the population grows. The velocity of money, the speed at which cash moves through the economy, has dipped to levels last seen in the 1950s. Personal consumption charts trace the outline of an aging society, with every birthday pushing spending a little lower. What feels like a private struggle is in reality a demographic undertow. Multiply Raoul's father by 50 million, and the result is a silent nationwide pullback. Every cutback at the kitchen table becomes lost sales at the grocery store, the car lot, the local diner. The numbers add up quietly, but the pressure is everywhere. The Federal Reserve's balance sheet has ballooned to levels that would have seemed impossible a generation ago. In 2007, the Federal Reserve held less than $1 trillion in assets. By 2026, that number is closing in on $8 trillion. Each new crisis, financial, pandemic, or otherwise, has forced policymakers to buy more bonds and mortgage securities, injecting cash into the system and pushing interest rates to the floor. The stated goal is always the same: keep credit flowing, support jobs, and prevent deflation. But behind the headlines, a deeper force is at work. As millions of Americans retire and cut spending, the demand for goods and services weakens. Fewer workers, more savers, and a shrinking birth rate all drag on prices, making it harder for the Federal Reserve to hit even modest inflation targets. Charts tracking the Federal Reserve's balance sheet against the share of young people in the population reveal a near mirror image. As the proportion of births declines, the central bank's interventions grow. Japan, 10 years further along this path, saw its central bank's assets reach nearly 130% of GDP in a desperate attempt to fight persistent deflation. The United States is following the same trajectory, with the Federal Reserve's balance sheet projected to reach $8 trillion, matching Japan's experience almost year for year. The tools that once worked to revive growth now run up against the hard limits of demographics. When fewer people are born and most of the population is saving rather than spending, inflation becomes mathematically elusive. The Federal Reserve can expand its balance sheet indefinitely, but it cannot reverse the drag of an aging society. A single number now determines the fate of millions: $53,000. That is the median home equity for an American household nearing retirement. It sounds like a safety net, but in practice it buys just 1 year of basic living expenses: rent, food, bills, and medical care. Once that is gone, there is no cushion left. For many, the only option is to cash out, downsize, and start over somewhere cheaper. Manufactured home parks and trailer communities have become the default destination, not by choice, but by necessity. These neighborhoods, once seen as temporary or last resort, are now swelling with new arrivals, former homeowners trading the illusion of security for lower costs and a shot at survival. The consequences ripple outward. Millennials, already squeezed by high rents and student debt, find themselves blocked from ever buying in. Home prices remain inflated, propped up by retirees unwilling or unable to sell at a loss. Inheritance, which once promised a path to stability, is delayed or disappears entirely. Instead of passing down assets, families are pooling resources just to get by. Multi-generational households become the norm again, echoing an era when several generations shared a roof out of necessity, not nostalgia. The American dream of retiring in comfort, handing off the family home, and moving up a rung has quietly stalled. For millions, the future is not about climbing, but holding on. 10,000 Americans retire every day, and the system built to support them is buckling under historic strain. As demographic tides shift and savings fall short, the risk is not just personal, it is national. How we confront this silent crisis will decide who thrives, who struggles, and what kind of future we are willing to accept. The real reckoning starts now. Share your thoughts below.